Okay, this is one of the most important videos I've ever made on the channel so far, and I've only been a month into my channel, but it's still a pretty important video because I think it is the backbone for a lot of the investments I made, and it's also going to be the backbone for a lot of investments you make if you follow Cathie Wood. There is one scientific principle, one principle that exists primarily in physics that ultimately determines the logical foundation for why any of her arguments make any sense. And if you are invested in any of the Cathie stocks, you're invested in ARK, or you're just at least curious about disruptive innovation and what the sort of idea behind it is, what the concept around it is really important to watch this video and to understand it. We're going to do a deep dive into this video, trying to really understand the concept of Wright's law. Wright's law is the foundational thesis by which Cathie Wood is able to make the argument she's making. It is the reason why Tesla worked out, and we're going to get into that in a second. And if it continues to be correct, it is the reason why ARK will actually have those 40% compounded year-over-year returns that Wall Street thinks she's crazy about saying over the next 5 years. But if this is true and this continues to play out, that will actually happen over the next 5 years. So in this video, we're going to go over very specifically what Wright's law is, what is the difference between Wright's law and Moore's law. Moore's law is a little bit more common. You might have heard of that before. And by diving deep into it, we're going to go through some case studies, and then we're going to really understand how that implicates the rest of the stocks that she's invested in, overall the psychology behind why she's invested in those stocks. So let's hop into the computer and let's talk about Wright's law. What is Wright's law? It was pioneered by Theodore Wright in 1936, and it aims to provide a reliable framework for forecasting cost declines as a function of cumulative production. That is the first really important thing to understand. If they can forecast, and when I mean if, I mean an investor, the cost decline of something that is being produced at a higher rate, then they can ultimately calculate demand and supply dynamics for that particular thing that they're trying to understand that is forecasting a cost decline, which means that they can evaluate a stock price. This is what happened with Tesla. Cathie Wood was able to apply Wright's law to understand how battery costs for electric vehicles are going down over time, even though there's continuous production, which led her to this bull case of a $5,000 price target or $4,000 price target when no one thought the stock was worth more than $100. This law in particular, the nature of cost declines as a function of cumulative production, is what gives her that foundation. Specifically, it states that for every cumulative doubling of units produced, costs will fall by a constant percentage. So when units in the specific thing that you're measuring within Wright's law are doubled constantly, there is a constant percentage in which it is also reduced. Theodore Paul Wright, we don't have to talk about him. You guys can look him up, but he was basically studied airplane manufacturing, and that's where he got an understanding of aircraft production. And by understanding aircraft production, he was able to develop essential statistical tools that provided accurate information. Now, Wright's law formula, this also is important, but we're not going to talk about it too much. Y equals AX B. Y is cumulative average time or cost. X is cumulative number of units. A time. B, the slope of the function. Now, here's the most important thing. What is the difference between Wright's law and Moore's law? This is where we get into the juice of it, right? So Moore's law was named after Gordon Moore, and it focuses on cost as a function of time. So specifically, it states that the number of transistors which are on a chip, and chips, again, given the semiconductor chip shortages we have, they are vital to everything, particularly in hardware and electronics that we have in society, would double every 2 years. So this law stated that every 2 years, the number of transistors on a chip would double, which means there would be this exponential growth of how technologically advanced a semiconductor chip could be, which would obviously lead to the iPhone, iMac, all those crazy innovations. Wright's law, on the other hand, forecasts cost as a function of units produced. And this is the core difference. That's the first thing that's important to understand. That Moore's law is focusing on cost as a function of time. Over time, what happens to the cost? So if you have those two in the variables, that's like on an X and Y screen or X and Y graph, you would then be able to measure it from that perspective. Wright's law is saying how many units are actually produced within a certain product or good that you're trying to produce, raw material usually in these cases, and then what happens to the cost as a function of it being produced, not just over time, but as a function of the literal amount of the things actually being produced. The important thing for ARK is that measured from 2010 to 2015, they found that a price forecast based on Wright's law was actually 40% more accurate than Moore's law. It doesn't mean Wright's law doesn't have problems. I'm going to leave the articles in the description so you guys can read some of the negative cases or some of the reasons why it's not the most accurate. But as a result, as a comparison to Moore's law, the resulting emphasis was that Wright's law is more accurate in order to determine how we understand costs. So let's look at one thing real quick. Let's look at a better comparison of Moore's law and Wright's law, and then we'll get into the actual case study for why Wright's law is important. So this is an article they wrote in 2019 that we only have to go through the first couple paragraphs. It's really important, right? So When Gordon Moore wrote every 2 years in forecasting the double of transistor density and the consequent of halving of computation costs, meaning that every time it doubles, the cost of the computation power would go down because of it doubling, Moore implicitly assumed that the consumer demand would increase in tandem with production, meaning that as there's more production, more consumers are going to want to buy things that have semiconductor chips in them back in the 1960s. If transistor demand had faltered, Moore's law would have failed. That's the important thing to understand, that if the demand for Nintendo DSs and Game Boys and iPhones and all that stuff just wasn't there, this theory itself wouldn't make any sense, because then it wouldn't be correct that the cost would decrease, because there wouldn't be any demand for that to be able to sustain the cost decreasing. So reducing the marginal cost of a chip would have done nothing but shrink the market, meaning if there's not people actually buying it, reducing the cost of the chip wouldn't do anything, because there isn't a market for the chip to be served to. There isn't a market that's actually actively buying the products, which wouldn't lead to the market expanding and growing, and wouldn't lead to the chip prices declining even more exponentially over time. The market has to increase for this to make any sense. It's kind of like a network effect argument, right? For YouTube to get bigger, more and more people have to upload more and more people, which gives more and more content for people to consume. So you kind of want to think of it like that. As a result, companies would not have invested in the research or production capacity to drive costs down. Moore's law was only a law because demand scaled enough to justify the increased investment. This is the killer argument that ARK's team is making for Moore's law, which is that it's not this scientific theory that makes sense outside of market dynamics. Market dynamics, i.e. enough demand scaling to justify increased R&D costs by major corporations that have the billions of dollars to put into the research for how to decrease the cost of these chips, which would lead us to be able to get an iPhone for $1,000 when, it could cost theoretically $10,000-$15,000, is what ultimately produced the ability for this law to make any sense. If there wasn't demand, companies would not be able to invest in the R&D around Moore's law, which means the market would simply not expand, which means it wouldn't become a law. There wouldn't be any correlation that would ground it as a scientific principle or a physics principle, because demand is the center at which costs go down in the first place. Research and production drives costs down. Research and production costs when companies recognize that there's enough demand to invest in that research and production. So saying in a nutshell that every 2 years chips would increase on transistors as a result of, and that would drive the cost down, doesn't make sense if there's not enough people buying the product in the first place. So the assumption that costs would decline continually, the basis of Intel's product innovation cycle, has not withstood the test of time. Moore embedded in his law an assumption that over time, unit demand and hence production volumes would respond to continuous price declines. Empirically, and perhaps misunderstood by the marketplace, the growth in unit production of transistors has slowed dramatically over the course of this business cycle. So that's sort of the argument here, that this is actually not necessarily true. As a consequence, and not surprisingly, the price decline for computation has begun to plateau, meaning it's not declining anymore as it should be with Moore's law, because there's not that much demand. The public proclaims the end of Moore's law, not realizing that it has been flawed all along. So then we have this chart, right? This is the growth in number of transistors produced. This is from a 7-year rolling average from 1973 all the way down to 2017. As you can see, it's generally going down. Now, the argument here is that if Moore's law is flawed, what is the best way to forecast the technology cost decline? And instead of forecasting cost as a function of time, such a formula should incorporate the mechanic behind cost declines, which is production volume. And that's the argument for Wright's law, which is what we're going to go into the case study right now. Again, if we understand this, we better understand why she was right on Tesla, and we better understand why there is a larger opportunity in the marketplace for innovation stocks. So let's look at a real-life case study. Lithium-ion batteries offer a good case study highlighting the benefit of using Wright's law. Based on Moore's law, and as shown in the chart, most analysts would conclude that lithium-ion batteries matured by 2005. The reason for this is because we see it here. So it was about 3,300 in 1995. It kept going down as a result of increased demand and increased production. That's what happens when you have economies of scale. And by 2005 to 2013, we see the price of a lithium-ion battery. It looks like it's almost like $400, $300, is pretty much the same, right? It's not declining anymore. So for 8 years, it doesn't decline, even though it was declining from 3,300 down to 400 over the previous 10 years. After 2 decades of declining roughly 10% on average years, lithium-ion flattened out. Now, Those 10% declines push the unit cost of lithium-ion batteries across a critical threshold, enabling the production of electric vehicles at scale. This is really important to understand. This cost decline was the basis for electric vehicles. One 200-mile range electric vehicle has as much battery power as 5,000 iPhones. So like the worst version of a Tesla that goes 200 miles has as much battery power as 5,000 iPhones. So if just 1% of auto sales were to convert from gas power to electric, they would more than double the demand for batteries relative to those required for smartphones globally. So if 1% of the entire auto industry market was to go electric, which was their hypothesis back when they were evaluating Tesla, right? This was the sort of intense research they did to understand why Tesla was an outlier. Then the demand for batteries, lithium-ion batteries that are these sort of rechargeable batteries that are necessary for electric vehicles, would more than double because you only need 1% of this to transition. And because 1% or one car is equal to 5,000 iPhones, that means 1%, you're talking about millions of cars, you're talking about millions and millions of batteries that have to be produced, which due to economies of scale would ultimately allow the cost to go down. This is their argument for Wright's law, which is that cost production goes down as a function of the number, or cost of a product goes down as a function of the actual number of products that are produced. Recognizing that batteries are about to hit this tipping point, analysts could have forecasted, so this is where she's throwing shade at Wall Street. It's like, you could have done this. It's not that hard. That the time required for the cumulative doubling of production would drop precipitously. They use that word to be very pretentious right there. They did not have to use that word. That's just me being a word hack, but like, that's interesting. And that the declining cost would reaccelerate as shown in the following charts. So here we have the next chart, right? The number of years between cumulative doubling of production for lithium-ion batteries. As you can see, from 2000 to 2019, the number of years between it doubling for production is going up and up and up, which means it's starting to, the demand for it is starting to increase, in terms of production. Then we have the lithium-ion battery decline model, or the decline model that's ultimately declining. And as you can see, with the cumulative number of kilowatts produced in thousands, we start from 10 to 10 million. The cost per kilowatt per hour is also declining as well, which means Wright's law, not Moore's law. Wright's law saying the number of stuff produced as a function, or the cost as a function of the number of things produced, not as a function of just pure time, is what's actually leading to a 40% reduction in their models of batteries, which is a much better indicator for a market, because electric vehicles are obviously at this point, multi-trillion-dollar market opportunity, and batteries are at the core of these making any sense. Batteries are at the core of electric vehicles actually being a thing. This model, via Wright's law, actually determines and facilitates the ability for people to recognize why costs are going down, and then leads to those costs going down, which leads to the ability for Tesla to open up a ton of factories and actually be able to open production at scale. So it concludes by saying the decline in prices has opened up new segments of the auto market to lithium-ion batteries, which in turn is pushing them to an even larger market, utility scale energy storage. So let's conclude and let's talk a little bit about what's going on here. Moore's law says that every couple years, the costs of producing something are going to decline. ARC is saying that scientific law is incorrect unless you take into account market dynamics. If there is not demand for the thing that you're saying is going to reduce in cost, then you can't just say, oh, every 2 years it's going to decline. Like, that doesn't make any sense. Like, why would it decline every 2 years just because technology gets better? That doesn't happen unless there is something undergirding the basis for that technology to want to get better, which is demand. Demand from consumers, demand from the economy leads to things changing. That means that Wright's law, that's measuring the cost of something declining as a function of how much of it is produced, actually serves as a framework for a company that's analyzing a stock that requires certain things to reduce in price in order for them to scale their business and have economies of scale and have major cost declines that allows them to become profitable, et cetera, means that we have to look at the amount of the amount of demand associated with a certain good, in this case, lithium-ion, which is what I went over, and how much is being produced based on that demand. So in the charts that we saw, if lithium-ion is being produced at hundreds and thousands of units per year, the cost is going to go down with it being a function of the production volume. That's what actually gives the ability for a economy or for a stock that's going after a big economic opportunity to put a dent in the economy, which is what happened with Tesla. Tesla was going after electric vehicles. Battery costs were going down because more batteries were being produced. Again, this really strong argument about 1% of auto sales equals 5,000 iPhones. 5,000 iPhones take a lot of batteries, but 1% of auto market transitioning is millions upon millions of cars equaling millions upon even billions of iPhone batteries if we were comparing them, which means there has to be so much more production that the costs inevitably have to go down. And that's just a general principle that as you produce more of something, the cost for things go down. This is what happened with solar panels over the past 10 years. More and more companies started producing solar panels. So instead of solar panels costing like $10 a panel, now they cost 50 cents because the nature of supply and demand is if there's more of something, the price is going to go down, right? That's what Wright's law is indicating. So for Cathie, her argument is that this scientific principle that is measured within the respects of not philosophy, but actual practical market dynamics and production volume is the basis for us to determine that artificial intelligence and the training costs for artificial intelligence are going down. Energy storage costs, meaning how much does it take to actually build something to store energy from the sun, for example, that's going down. Autonomous vehicle using data through AI and the training models for that, as I mentioned, that's going down. Battery storage, that's going down. So she makes this argument that there are exponential growth curves within different sectors, the main ones being robotics, AI, genomic sequencing, and autonomous vehicle data, which is part of AI, and then energy storage, that are all converging at the same time, which is her argument for why 40% year after year growth is going to happen within these types of stocks, because these exponential growth curves, as a result of Wright's law, apply to all these different businesses, whether it's Palantir or whether it's Teladoc or whatever other company she's invested in, is the foundation for them to actually reduce their costs via demand production, or via demand for the increasing production of whatever thing that a company is using, which is going to lead to a massive price decline and which is going to lead to huge opportunities for these companies. So one example is Palantir. That's a stock that I'm invested in. Her thesis for Palantir is that the cost for training AI models, and AI is central to all forms of data is central to all forms of company, is reducing exponentially because there is more production of these AI simulated models because there's more demand for this stuff. Every company wants to use and integrate AI and machine learning into their companies. If that cost is reducing exponentially year after year because there's so much more demand, then the production of that is only going to go up, which means the cost that it's going to take for a company like Palantir to be able to facilitate these services and make these services even better is going to go lower and lower, which means their products are going to get better and better, which means they're going to be able to scale more efficiently and effectively, which means they could potentially have the entire market share of artificial intelligence services and be like a one-of-one company in that market. And same thing for all these other stocks that she's invested in. And that's why Wright's law is so interesting. And that's why I really wanted to understand it a little bit more deeper, because now I think as an investor, I understand it. Now, could she be totally wrong about this? Could cost decline not happen because production doesn't happen? Could demand slow down for certain things? Yes. It's just now I kind of recognize why she's so damn confident, because it's like, why would it? Why would the cost go down? Why would demand for this stuff go down? We're not going to lose demand for energy storage. We're not going to lose demand for artificial intelligence and data analysis. We're not going to lose demand for electric vehicles. So if all this stuff is only going to go up and up and up, it seems to like you start to see her sitting out on the island and you're like, I might want to stand with her on the island because 40% year after year, it sounds crazy. And I don't know if it's going to be correct, but it's really exciting to see what happens over the next 5 years. Because if this thesis is correct, then it looks like she's going to be correct or get close to being as correct as she thinks she's going to be, which is super, super interesting. So yeah, those are my thoughts on Wright's law, and those are my thoughts ultimately what's happening. I'm going to leave you guys with this. There's a quick, I think 30-second video I'm going to leave as the last clip of this. I want you guys to see her talking about exponential growth curves converging against each other. I'll leave you with that. I'll leave the full interview to where she talked about that in the description. Thank you guys for watching. My name is Amit, and this is exciting times to be investing in some of these stocks. I'll see you on the next one.
That, most people have never seen exponential growth, and they certainly haven't seen convergence of exponential growth trajectories that we see, for example, in autonomous taxi networks, the convergence of robotics, energy storage, and artificial intelligence. So one S-curve feeding another S-curve. We think that delivers $10 trillion in revenues in year 10 in 2030. Now, if that's right, that's from zero. The returns are going to be phenomenal for any company involved in that particular space.